Good morning, ladies and gentlemen. Well, what a very weird week we've had, and I fear we will continue to have weird weeks. After one day of risk off on Monday, as more or less expected, we had a continuation of very strong risk on, which was not expected. So we had a drop in the risk dial from 82 to 56 on Monday, and then boom, straight up, and we finished at 86. The moving averages are still going out, and it looks to me like we will continue this trend of more risk on for longer, and then brief periods of risk off, which are bought into very heavily. There is absolutely no stopping it at the moment, and we will look at the reasons behind it in the video, and what the bond market is saying, and how far this bout of risk on could take us. Well, the yield curve has probably done as much as it's going to do for the next few weeks on the downside. It looks, we touched in the 2s, 10s, we touched the objective, which was around the 98 basis points. And then when risk on came, we just bounced off it. I would have thought a range between this 118 area and 98 is going to be what we get in front of the Fed, and after the Fed, what we get going into Jackson Hole at the end of August. I think August is going to be relatively quiet because people are not going to be willing to put on very large positions ahead of what could be a change of policy by the Federal Reserve. And people are going to be very much wary of having any kind of positioning going into that. I doubt very much that this Wednesday's Fed is going to be important, simply because I think that they will reserve any changes for Jackson Hole, and whether they wish to pre-announce anything, I very much doubt. So I would have thought that bonds next week are going to be on a back foot. They're just going to be weary of any kind of massive positioning, and really a range in the 2s, 10s between 98 and 118 is all we can expect. The other parts of the yield curve basically did much the same as the 2s, 10s. The most important one, the 5s, 30s, basically is rejecting this 105 to 109 area every time it gets there, and it just can't hack it. Back it comes towards 124. 124, I think, is now the swing level. We could easily get little bouts back down towards 139 in the next couple of weeks, as people get rid of positions ahead of Jackson Hole. As I said, I don't think Wednesday's Fed is going to be very important. But really, I think now the odds are that we get a little bit of steepening in the yield curve, but very modest. And the one that's interesting is the 10s, 30s. We just cannot do any better than 56. This kind of level, the 64, becomes the swing level. I think the odds are greater that we go down towards these levels, towards 70, 71, rather than reattempt the 56. And that will just, to me, show that the market does not know what to do now. There is inflation. The inflation expectations have dropped, but they've probably dropped too far too quickly. And it'll take some time, and it'll take probably most of the next month for the next move, significant move in the yield curve to become evident. I don't think anything is gonna. I don't think any clues are going to come from the yield curve over the course of the next couple of weeks. In the US, the individual tenures have actually done very little, but I would have thought that the pressure is likely to go on the upside over the course of the next month. I think this is the 5-year note. I would have thought that over the next 2 or 3 weeks we will slowly meander towards the 85 to 79 area, which seems to be a very neutral area for the 5-year note. Again, Fed on Wednesday, but I don't think that, I think any dips ahead of that will be bought, and I think certainly after the Fed these dips will be bought. People will want to prepare themselves for late August. If we go on to the 10-year note, same thing happened. Let's enlarge this area. We basically bounced off the 200-day moving average, and I would have thought that over the next couple of weeks we will be stuck between the 50-day and the 200-day moving average, going and settling around this 140 level. And in the 30s, which was basically the steepest of the falls, now we're getting the largest of the retracements, and really the easiest way, the easiest position to reach, I would have thought, is somewhere around here, around the 200 to 210 area, and wait and see what the developments are, because as long as inflation numbers keep on being high and higher than the market expects, it's unreasonable to expect the 30-year note to take much more of a leadership from these levels. I was hoping to get another 4 or 5 basis points. We didn't get it. It makes sense. We had the risk on. And now I would have thought a period of settling around this 199, 200 and 210 is reasonable. We do have a whole load of stuff in August. We have the debt ceiling, we have Jackson Hole, we have a whole load of numbers for inflation. So really looking for much better levels in the 30s at this moment is unreasonable. What cannot be doubted and argued against is that European fixed income looks far more dovish than US fixed income. We've had the ECB, basically Lagarde could not be more dovish. The only thing that prevents her from being more dovish is the German membership on the board and the fact that her dovishness cannot be unanimous. But that is being shown in the prices. The bubble is, even after falling, it just continued to fall all week in terms of yield. We are now at the very, very crucial -71. Below -71, we have nothing until -76. I would have thought -71 will continue to hold, simply because the yield curve there continues to flatten. If we change that for a 10-year, this is the Bund. The odds are that we could easily come down towards this -49, -50 area. And even the French, and if we have a look at France could easily fall down to this -20 kind of level. And that just shows you that dovishness in Europe continues unabated. The BTP also is doing a very nice ABC, and really you don't have much support until you get to the 54, 55 area. So Europe is definitely looking much more bullish than the States. The States is standing pat or going backwards, while we have the European bonds doing better. And this actually, it was pointed out to me that we were at the lowest level since February. And as I said, I don't think that we are going to go too far away from this 175-point differential between Germany and the US. So we probably have a few more basis points. Could we go to this kind of level, 179? Yes, easily. So 175 to 179 is the area that I'm looking for this to reach. And that is actually going to be slightly bullish for the US dollar. So this is probably the safest trade to have on, is to be slightly long of Europe and slightly short of the US, looking for this 175 to 179 to 180 area. Makes fundamental sense at the moment, and also technical sense. The US dollar continues to be very frustrating and continues to fail at this 93.14 level. I think that these dips are going to get bought, and eventually will break up towards this 94.83 kind of area, maybe even 95.07 on the dailies, and that kind of level is going to be probably a good sell. As I showed you, the interest rate differentials are now moving in favor of the Dixie. Odds are that unless the Fed is extremely dovish, which I cannot expect, I don't see why they would be, because there would be a complete change in their stance over the course of 1 month, when the data has been, if anything, confirming their view. I would have thought that the Dixie is more likely to break upwards. I have not changed my mind. If we have a look at the Euro USD, I would have thought any move up towards the mid to low 119s is going to get sold, and we will probably see this 115.25 area, where I would have thought there will be very, very good weekly support between 115.30 and 114.40. That kind of level will get everyone excited. As I said, talking about head and shoulders, blah, blah, blah. I don't think that will hold, and we will go back up towards 118. That is all we can expect from the dollar. Still very boring, still very little reason to expect a big fundamental move. Given my expectations for US bonds and given my expectations for the Dixie, it's tough to see gold doing very much on the upside. And, I keep on saying that 1830 to 1850 area is very key. And while it cannot break above there, and it hasn't broken above there for, we've been trading around, and it keeps on failing at that level, which coincides with the downward trending 200-day moving average. We are more likely to expect, you can see how every attempt higher has been sold. To me, that says that we will, at some stage, if the bond yields, do very little, and the dollar breaks higher at some stage, we will retest the 1764 area, and that's going to be key for the next $100. I think it's more likely to bust 1764 now than to go through 1830. But I'm not touching it simply because I think the risk reward of trading in gold is almost zero. There is so little to be expected. You can make $10 or lose 50. I would have thought the odds of being long here are just not good. I don't see any catalyst which is going to move the price fundamentally, and therefore I just don't see any point in being overweight in gold positions. Just absolutely, the risk reward is not there. In terms of spreads, well, I was very wrong last week. I thought that the ratio between SPY and gold would come back down towards 240, but no, it's making new highs, new all-time highs on the move, and the ratio against TLT is being held quite steady and above the very key 2162 area. As long as it stays above, gold is relatively more bullish than bonds. But since bonds are doing so little, gold is also doing very, very little and maintaining these levels. What is interesting is against this chart here, which instead of looking at SPY is looking at ACWI, which is the rest of the world stock markets. So we're not looking at the US, we're looking at everything. And here gold is actually holding its own much better against equities, much better than against the US. It's the US equities which are driving, but I think it's going to be interesting and important if we can now start taking out this level, and it will show you that gold is actually underperforming even the rest of the world, which is nowhere near as bullish as the US. So I've got a reminder here at 61.93, 62. If it starts going through there, I think the pressure will start coming onto gold, and money will start coming out of gold and going into the rest of the world equities. So that's what I'm looking at. I was totally wrong. Gold is not being bought as during a period of risk off as a neutral asset. People are actually divesting themselves, they're selling it and putting money to work in a risk on asset, i.e. equities. So that is why I really cannot expect gold to do very much to the upside for the time being. I've been asked to take a longer term look at oil, although I'm in no way an expert. What I can conclude is that you can see the weekly hammer candle. We're still definitely in an uptrend. What we need to do is we need to break these levels. You can see how actually, this is going to be a very important level, 76.90. You can see how basically when it fell through, it collapsed. We've touched it now a couple of times. It probably needs a little bit more consolidation before it breaks through. But it's interesting to note how that 76.90 level is very, very important. If we get rid of the weeklies, what is very noticeable is that even on a 300-minute chart, the 200 period moving average is going up. It's only on a 60-minute chart that it's topped out, but all that suggests that we need a few more, a little bit more time to turn it back up. So really, trading between 68 or 69 and 75, 76 for a while is going to recharge. On a daily, this just does not look bearish to me. It just, we had a period of risk off, we came off, now we've got a period of risk on. We probably just go sideways before breaking up. And that is really what the chart of DBC is saying. If we go back to the the weekly chart of DBC, you can see how we are in DBC, we're still lagging very much the oil chart, because the equivalent of this 24.39 is that 77 area in oil. To me, this says that DBC at some stage, it keeps on, if we enlarge this area, you can see how it just keeps on holding these very important levels between 1860 and 1840 on weekly closes. It just keeps on holding these levels. To me, that suggests that at some stage, when it's done enough correction, it's just going to break upwards. And that is why I just can't get hugely bullish of bonds at these lower levels. I think the odds are that we are still going to get a move higher in commodities at some stage. Probably not until the summer is over, but there you have it. I still think that commodities are a much better bet than gold. If you want to be long of something which is, a hedge against inflation, it's got to be commodities, DBC, rather than GLD. What did we learn about equities last week? Well, we learned never to be short of them ahead of earnings. You saw that expectations that JPM revised up the earnings to $205. 205 times a 22 multiplier gives you a very, something just above 4,500. And I guess the market responded as it was expected to respond. I think the most interesting thing was, this was Monday, was the last few minutes rally, which made it close above 42.55. You can see how we spent such a long time, trying to break through 42.55. These are daily bars. And once we did it, and when did we do it? We did it on the 24th of June. We never basically looked back. Now, not only did we close above 42.55, but on Friday we broke through the previous high, which was 43.84. 43.84 now on a daily basis becomes the support. We should not, we would only be stopping a trend if we closed below it. This is extremely impressive. Okay, extremely impressive. If I take it down to a 195-minute chart, we can basically talk about it like this. I got really scared down here, really scared. As it turns out, there was no reason, because this is the close of Monday, above 42.55, and the next day, basically, as soon as it closed above 43.18, I knew that the jig was up. The fact that we could not go below 43.18 on the close on Tuesday told me everything I needed to know. Buy calls, get some stuff in, and let's see where it goes. And boom, the odds always were that we would go and touch the top of the Bollinger Bands on this 195-minute. That comes in around, in the next couple of days, it'll come in around 44.40. If we have a look at a daily, we touched it on Friday, so that means that we are going to have quite a difficult time going much higher over the course of the next couple of days, and certainly ahead of the Fed. It will be unreasonable to expect that the market is going to await the Fed at the top of the Bollinger Bands. That would give you too good a risk reward to the downside. But really the question is, do we break on a daily basis below 43.84, yes or no? I would have thought that the odds are not that high. This is on a weekly basis. You can see that this area, as every time it's been touched, 43.27, sorry, 42.47 to 42.32 is amazing support. We just know that this area now is hugely, hugely, hugely important. We couldn't break above it for many, many weeks. Then we did, retest, and now the odds become greater and greater that this is just a continuation move in SPX. Even the Dow Industrials on a 195-minute basis is showing that we have further potential to the upside over time. This chart is far less bullish than SPX. But what did we do on Monday? We came down to the 200 period moving average, and boom, straight up, and we actually closed above the previous high at 35,032. That to me is an indication of a market which over time wants to go higher. I would have thought any dip down towards this 34,200 is going to get bought hard. Can we have a dip next week? Of course, but really I wouldn't get even neutral unless we see closes below the levels I just mentioned in SPX. If we look at NQ, the situation is very clear. I mean, this weekly chart to me, it's pretty amazing, because we keep on touching the top of the Bollinger Bands, coming off, touching the top of the Bollinger Bands. We had a very, very strong move up of, 1, 2, 3, 4, 5, 6, 7, 8 weeks up. We finally had a little corrective week. Sort of people got all excited, liquidating, and boom, straight back up, new highs. If we have a look at the 195, I mean, it's tough to argue how bullish the market is trading. Now, whether the levels are vastly overbought or not, that is neither here nor there. This is still a bullish market longer term. Whether we come back down towards the 14,575 is neither here nor there. This is still a bullish chart. Every single one of these charts is bullish. People keep on saying the transports. Well, yes, the transports are less bullish, but they are, this could be basically just a consolidation phase in the transports, and then we bust higher over time, take out the all-time high, and that'll be that. This is the all-time high close, 15,943. The day we bust that, there will be confirmation that we're again in another leg of the bull market, and God knows where SPX is going to be at that time. So I really would not get bearish of US equities. They are leading by a long way. They are so strong, it's incredible, and I think JP Morgan as a result is right. 205 times 22 or something like that gives us eventually mid 4500s. The way the VIX is trading is also very interesting. This is a daily chart. You can see that the spikes are becoming lower and lower, and we keep on coming back towards this 1558, 16 area. As soon as it just cannot hold more than 1 or 2 days above 2005. And then as soon as it dips below 2005, all the pressure comes off and the market just melts up, and the VIX just goes down towards the 16 area. On a weekly basis, much the same kind of thing. If we cannot close any week that we can't close above 2250, indicates that 2250 and above is a good sell. Every time the market gets up there, it just gets smacked and it closes back down way below, To me, the odds are that we basically trade around between 16 and 20 for the foreseeable future in VIX, and then we probably break down, which is what nobody's expecting, and we go back down towards 12. But that is many weeks away, I think. I don't think the VIX is a good sell anywhere around the 16, 17 area for the next few weeks. Don't forget the market needs to do a lot of positioning, or position squaring, or addition to positions, or whatever ahead of Jackson Hole. That is going to be a very seminal event, and the market knows it. So I think a lot of positioning needs to be adjusted before then, and the easiest way to adjust it is by buying puts, or buying calls, or buying some kind of an option to adjust, and that's going to keep the VIX relatively bid compared to the market. What the Chinese are doing to their technology companies, what a communist regime who really does not care about the price of equities is doing, is spooking EEM, and with good reason. This EEM chart, and we'll look at the spreads a bit later, is beginning to look quite worrisome in the short term, because this is what's happening. We are getting basically an ABC retracement, which could easily, we're still closed above 52.08, but it could easily start in the next 2 or 3 weeks closing below 52.08, which would target 50.23. And eventually, I would have thought, if this is an ABC, it will target 48, the 48 level, 47.93, and that should be a really good level to buy it and look for much higher prices again. If we look at the spreads, I mean, what can I say? I've looked for a turn in this EM-SPY relationship for such a long time, and I keep on being wrong. Thank God my allocation to EM is very low. New lows, new all-time lows in this move. It shows no reason of stopping. If we look actually what's happening to EM, EWJ, this basically tells you how constant the relationship is between EM and the Nikkei, and that also shows you why the Nikkei at the moment is not performing. The Nikkei obviously cannot perform without EM being on the same page. While this is, let's do this one, which is the easiest, EM against FEZ, i.e. the stock 600. This one also can't really perform if EM is not performing. What is that telling you fundamentally? Is that Europe and EM and Japan are much more tied together than the US, and that actually makes fundamental sense, doesn't it? The US has got its own technology sector, which is the leader of the world. It has, basically, the US is a much bigger island to itself. Europe is very tied into China. Japan is very much tied into China and the Pacific region. And unless those are performing in terms of price, then nothing else performs. Their individual markets cannot perform as well. If we look at the Nikkei, really the Nikkei would have to break 26,910 for this trend to start looking bearish, and then probably on a weekly basis. This is just consolidation. The big question is EEM going to break down towards that 48 area? Because if it does, then the Nikkei will also break 26,910. That is pretty clear to me. And then we don't really have support until this kind of area, which is just the mid 24,000s. That's why I'm, a little bit weary of Nikkei at the moment, simply because you can see every bout of buying makes a lower high. This is healthy consolidation if it's looked on a weekly basis, but it could take an awful long time, and it could easily close below 26,195 if EM goes down towards 48, dip into this area, and then it'll be a great buy. But for the time being, I would have thought the Nikkei, the EM, and to a lesser extent Europe, I'll leave them alone. It's such a trend in the US that you have to participate in the US. That's where the money flow is. That's where the bullishness in earnings is. That's where the mathematics says that you put your money to work. I would not get too bullsed up on Europe. Europe is still far too tied to Japan and EM to give you much outperformance compared to the US. I really would like to see some kind of decoupling between Europe and EM and Japan. I'm not seeing it at the moment, and therefore I can't express bullishness in anything else but SPX. I just cannot buy Europe at these prices. Whether they turn out to be cheap in the longer term or not, that's neither here nor there. But for the immediate future, SPX is the driver. You would have to get a lot of work done in SPX in Europe before I could buy it in front of the United States. We would have to get several closes above 41 for the next leg higher in Europe to develop. And while we did have a very nice retracement in Europe last week, it was just short covering. It wasn't initiation of very strong positions. We keep on failing to even reach the previous highs while the US takes them out with panache and goes much, much higher. So to me, the rest of the world is still tied together. The only one that can break free is the US. I wanted to leave you really with this chart of ACWI over SPY. And really this area here is very reminiscent to this area here. And you can see that once it breaks out of the triangle the rectangle that it made, it basically went about 5-6%. So really what this chart is saying is that the outperformance by the US over the course of the next few weeks could be in the order of 5-6%. And that, given all the relative charts of EM, of Nikkei, of Europe, does make some sense. It looks like the strongest is the US, followed by the stocks, followed by DAX, followed by Japan, followed by EM. And that kind of outperformance could be easily in the area of 4-5%, or let's call it 5%, which is what we saw in this move here. We could easily see that over the course of the next few weeks on the way down. I have updated all the levels in all the spreads on the yield curve. As I'd say, I think we could have a potential for slight steepening in the curve. But that, I think, is going to be a positioning relating matter. I don't think it's going to be signaling anything very much. I'm a better buyer of Europe rather than the US. I think that spread is probably the safest trade over the course of the next couple of weeks that will go out, i.e., European bonds will perform better than US bonds. And I think that the US is likely to perform better than EM and markets, developed markets overall. And that is probably, rather than being outright long, probably the better position to have. I still don't think that NQ will be able to really get away from SPX over the course of the next couple of weeks, simply because if the yield curve steepens slightly, that will take the wind out of the sails of NQ to a certain extent. I think NQ and SPX are very much tied within a couple of percentage points of each other. So I really can't see a huge outperformance by NQ over the course of the next 2 or 3 weeks. That can only come when the yield curve starts really to flatten, and I don't think that that can happen before Jackson Hole. Thank you very much indeed, and tweet you on Monday.